Source code speaking. Alea Hussein here. If you're watching the silver market right now, stop for a second, because what just happened is not normal, and almost nobody is explaining it correctly. This morning, a single data release hit global markets, and within seconds, gold and silver reacted like someone flipped a switch. Not slowly, not cautiously, instantly. Screens lit up, algorithms fired, and traders around the world watched silver push into a level that, just days ago, analysts were confidently saying wouldn't happen yet. But the move itself isn't the real story. The real story is why it happened and what the market is quietly revealing underneath the surface. Producer price inflation came in hotter than expected. Forecasts were sitting lower, and the actual number landed well above them. The moment that data dropped, metals reacted exactly the way assets react when markets realize inflation isn't cooling the way central banks promised.
Silver shot upward and immediately began testing a price zone that has been acting like a pressure lid for weeks.
If you've been following this market carefully, you already know this level matters, because earlier this month, silver tried to break the same area. Momentum was building, traders were positioning, and then suddenly the market froze. A trading halt hit, and when activity resumed, price dropped sharply. The move shocked people who weren't watching liquidity. But experienced traders know something important. Markets rarely move violently for no reason. When price is forced down quickly and then stabilizes, it usually means one thing: positioning. Weak hands get removed. Stronger money steps in. And now, days later, price has returned to the scene of that event and pushed through it again. That's where things become very interesting, because the next few candles tell you everything. A real breakout doesn't just poke above resistance, it lives there. Buyers keep price above the level. Volume supports it, momentum builds. But if the market only spikes above and falls back under, that means liquidity was taken and the breakout was rejected. Right now, the market is deciding which one this is. And just above this level sits another target that professional traders already have marked. But price action alone doesn't explain the whole situation. To understand what's really happening, you have to look somewhere most Western traders ignore: Shanghai. While silver trades in the low 90s in Western markets, physical silver in Shanghai has been trading significantly higher. That gap between Western paper pricing and Eastern physical demand has been expanding again. Not shrinking, expanding. That detail matters more than almost anything else happening in the market, because when two major markets disagree on price, one of them is eventually forced to adjust.
Paper markets can move quickly because contracts can be created instantly.
Physical markets cannot fake demand. If buyers are consistently paying higher prices for real metal, that means something deeper is happening. Demand isn't fading, it's strengthening. And when premiums widen during rallies instead of compressing, that's not a normal arbitrage signal. That's structural tension building between paper supply and real-world demand. Now add another layer to the story. During a recent period of extreme volatility, enormous volumes of silver contracts changed hands in a very short window. What made that event unusual wasn't just the size, it was the timing. Retail traders were essentially locked out while massive positioning happened behind the scenes. That's the kind of moment markets reveal their mechanics. Because if traders truly believed prices were about to collapse, they would simply roll their contracts forward and stay in the market. But that's not what happened.
A large portion of those positions exited completely. They took the cash, and they walked away.
In market terms, that behavior signals something important. Confidence in the structure is changing. People don't leave profitable games unless something about the game feels different. And while all of that was happening inside paper markets, something else was unfolding in the physical world. Metal continued leaving vaults. Inventories declined again. Shipments moved east, and buyers kept showing up. In parts of Asia, demand didn't slow down during price swings. In fact, lower prices appeared to bring more buyers into the market. That behavior tells you these buyers are not trading charts. They are accumulating. That difference between speculation and accumulation becomes extremely important during moments like this, because paper markets can create temporary volatility, but physical markets determine long-term reality. History shows that again and again.
Markets spend long periods building pressure quietly.
Prices move steadily while attention stays elsewhere. Then something changes. Capital rotates. Suddenly the move accelerates and everyone starts asking the same question at the same time. How did we miss this? Silver has been quietly stacking strong monthly performances for an extended period now. That kind of consistency doesn't happen randomly. Persistent momentum usually signals accumulation beneath the surface. But here's something even more important that very few analysts are discussing. Retail investors still barely own any silver compared to previous historic cycles. That's significant, because the explosive phase of commodity markets rarely begins when professionals buy. It begins when the public arrives. Once large numbers of retail investors start chasing limited supply, prices don't move slowly. They move violently.
Past cycles showed exactly that pattern. Demand surged faster than available supply, and prices accelerated dramatically.
Right now, we are not at that stage. Retail ownership remains relatively small, which means if participation expands suddenly, the system could experience pressure very quickly. And while all of this builds in the background, the global environment is adding another factor. Geopolitical tensions have been rising again. Governments are issuing warnings. Military postures are shifting. Investors are quietly looking for assets that hold value during instability. Precious metals have historically filled that role, not because they are trendy, because they exist outside the digital financial structure. They cannot be printed instantly. They cannot be frozen with a button. During uncertain periods, capital often flows toward assets that exist independently of political decisions. That movement has already begun appearing in the market. Within hours of recent developments, the total value of precious metals rose dramatically as money flowed into the sector. Those kinds of moves are not created by small traders. They are institutional responses. But let's remain realistic for a moment. Markets always contain risks. Exchanges can intervene during extreme price movements. That has happened before and could happen again. Physical demand in Asia could slow temporarily if industrial activity cools. Geopolitical tensions could ease. And if investors suddenly dumped large amounts of financial silver products onto the market, prices could drop sharply in the short term. Those are real scenarios. Serious investors consider them. But compare those possibilities with what the current data shows. Vault inventories trending lower. Eastern physical demand paying premiums above Western prices. Institutional capital gaining approval in major economies to allocate more into metals.
And despite volatility, long-term holders are not rushing to sell.
That combination creates pressure inside a market. And when multiple forces push in the same direction at once, price action, demand signals, capital flows, and macro uncertainty, markets tend to move in ways that surprise people who are only watching headlines. So where does that leave silver right now? At a level many analysts thought would take much longer to reach, testing resistance that has already proven explosive, with physical demand strengthening while global uncertainty grows. That doesn't guarantee what happens tomorrow. Markets never move in straight lines, but it does tell us something important. The narrative that silver demand is fading simply doesn't match the data. The deeper story suggests a market building tension beneath the surface. If the gap between physical demand and paper pricing keeps widening, eventually something has to adjust. Either demand weakens or price rises to meet it.
History suggests which one usually happens. So don't just rely on opinions, including mine. Watch the premiums, watch inventories, watch how price behaves around these levels. Because the next phase of this market won't be decided by social media debates. It will be decided by supply, demand, and the people paying attention early. This is Elias Hossein. Stay sharp, verify everything, and think independently.